Presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
No, not Larry. Kate Stalter today, sitting in for Larry. Got one more week here, which is great. Just having a lot of fun substituting here while Larry is getting some R&R. So, let's see. I'm kind of following some of the news today, what's going on here. The media's making much of Nokia and its pullback, but I gotta tell you, this is one of those things where this is just a stock that has not been on my radar for a long time. Couldn't even tell you when the last time I was tracking this particular stock. It's just been trending lower for, let's see here, since 2007. So I see we're having a little problem with the charts there on Tiger TV. We'll get that worked out for you here in just a couple minutes. But yeah, just Nokia is not something that I've been tracking for any length of time here since 2007, at least. Last time it had any kind of significant run-up was in the, let's see, early part of that year. And if you recall, I recall it very well. It was right around late October, early November that the whole market began rolling over and what that led to. So, yeah, in any case, just means that a lot of the stocks that you hear about so much in the media really are not necessarily ones that you'd want in your portfolio anyway. Not, I can't make a case why you would want this particular stock in your portfolio, and that's been true for quite some time. Okay, so let's see. I guess right now we can't use the charts, and I'm not really sure what the problem is, but I'm going to try anyway and go ahead and put this up. And I've put up an Apple chart. And Apple, of course, pulling back a little bit today. We were joking around there in the middle of, there we go. I'm going to reload stockcharts.com. I see. Our producer was looking at the wrong screen. I hadn't refreshed my screen there. Okay, hopefully you'll be able to see an Apple chart up there in just a moment. So you can take a look at that. And as most of you know, I'm sure it is undergoing a little bit of a correction, much needed. I was talking about in my show yesterday that it was not necessarily showing any sell signals. You know, that depends on your risk tolerance and whether you are whether you have a cushion in the stock that you've bought. So that really depends how you want to handle the stock. If you did come into Apple pretty recently and need to protect your gains, could be something you might want to start reevaluating at this point. But nonetheless, it's been running up for several months here, and like everything else that runs up for a long time, definitely would be something that you would want to see some kind of pullback, or not want to, expect to see some kind of pullback is probably the more operative word there, not to get into what you want to see or what you're hoping to see. So, in any case, that's what we're looking at there with Apple pulling back a little bit. Wouldn't be surprising to see a bit of a correction at some juncture here. Okay, so let's see here. I'm still kind of struggling with the charts here. I don't know what's going on today. I put up stockcharts.com, but apparently people are not seeing Apple. They're still seeing Nokia. So we'll keep working on this, and hopefully I'll keep getting updates on what people are seeing there. Okay, what I wanted to talk about today were some IPOs, because that's always just a very fertile ground worth tracking. We had an IPO, and it was a small one. Ericsson Air was the name of this one. The ticker is EAC. And that is, let's see here. Speaking of cell phone companies that were big maybe in the 90s, I saw that name Ericsson, and that was originally what I thought of. But this is not any kind of cell phone related company. In fact, I think they formed a joint venture with Sony anyway. This is Ericsson Air Crane, and let me see here. I think I have my charts working now. EAC is the ticker on this one, and it looks like it's not even in my database yet. So that's okay. We'll just continue working with what we have here. So EAC, Ericsson Air Crane, provides aerial firefighting and timber harvesting services. I'm reading this from Renaissance Capital on heavy lift helicopters. Now, how about that for a specialized business? This is a very small company. They raised $38 million. They priced their shares at $8 a piece. That was the low end of their range. So this is, let's see, market value of about $134 million. This could be an interesting one. It's got a good track record of earnings growth, revenue growth. Could be something to watch. One of the things that I will talk about a lot on the small cap show, and really it's applicable to any market cap at all, is the idea that newer companies, because their management in many cases, even if they were spun out from private equity, you see that a lot these days, not the sort of venture capital model that was more common a decade or so ago. But, a lot of these have management who are still very enthusiastic, full of new ideas. The company is in growth mode. And of course, that is true of something coming out of private equity. So these are often the companies that if you kind of do a scan of the market, something like an Apple accepted to this rule, these are often maybe about 80% or so of the best gainers on the market. When I say recent IPO, I mean, within the past 5 or 6 or 7 years in particular, but really you can go back to about the past 10 or 12 years and see some of these stocks that came on the market right now. If you're looking at something that came public maybe 99, 2000, if you can find some of those that are still around. But that time frame does tend to be very, very constructive for these new companies coming on the market. They're frequently among the best leaders. Okay, so I want to take a look at some of those today just to let you know we have this Ericsson Air Crane EAC. They don't have it yet in the stockcharts.com database, but a lot of other databases will have that already, and you can begin tracking that. So that's a new company. Let me show you a few. I have a few more minutes here in this segment. Oh, later on in the show, we have a terrific guest coming up, one of my favorite guests. His name is Edward Hornstein. He's an asset manager in New York City. Remember those old commercials for, I believe it was Pace Salsa, New York City. So he's just a terrific growth stock trend follower and always has a great perspective on the market. He's a very knowledgeable market historian, so he should be able to shed some great light for us on what is going on in this current rebound in the midst of a downtrend. So let's take a look here at Elli, E-L-L-I. Is the ticker on this one. Now, this particular company went public not too long ago, just a few months ago. I'm showing you a daily chart on there. This one went public actually about a year ago in April 2011. And you can see very easily on this chart, nice run up. I'm indicating it there on Tiger TV. I believe we do have the chart up there now in front of you. So you can see it is pulling back a little bit in recent sessions, along with the market downturn. Not unusual. That's what you'd expect to see. So this has had a nice run-up, a little bit of a checkered history when it comes to the earnings growth. Let me tell you a little bit about what this company is. They're an electronic mortgage origination provider. So, you can make whatever conjectures you want about how the mortgage business has been lately, but I can tell you this, that revenue has been increasing in recent quarters. And this has a market cap. This is kind of right there in my wheelhouse for the small cap show that I normally host on Tuesday and Thursday. Market cap of about $233 million. Very thin trade, about 85,000 shares a day. But nonetheless, nice chart on this one. It kind of, you can see here, I'm indicating the latter part of 2011 when it did correct. It kind of staged one of those typical post-IPO corrections. I can go over here to a weekly chart on Ellie Mae. There you go. So I've just refreshed that on Tiger TV. You can see a weekly chart. So you can see how it did. Really, this is just so typical. You will see this over and over again in the IPOs, how they tend to trade. A little pop after the IPO, and then a correction, and of course, this did coincide with what happened in the market in 2011. But even in better market conditions, when companies go public, you do see a pullback shortly after that IPO. So a nice rally lately. Let's see. I did mention that there was a little bit of erratic earnings history, but expected to be, let's see, earnings per share. Analysts see 32 cents a share this year. That would be a 33% increase over next year. Okay, so, you can't go to the bank with these estimates, obviously. It's just kind of a little bit of a guidepost of what kind of confidence the institutions have. And, of course, this would be thinly, because it's so thinly traded, not a whole lot of institutions in this anyway. That's the risk you take with the smaller caps. But that was one of these good performers that I wanted to show you. Let's see, I've got a couple more minutes. I want to revisit one that I believe we talked about yesterday on the Small Cap Show, and I also mentioned it when I was on Tom's show yesterday afternoon when I did my little guest spot on his show. This is Mattress Firm. Now, this is one that I like a lot right now, just because of how it's been performing. This thing is way out of buy range at the moment. This is a Houston-based company, market cap of nearly $1.4 billion. Again, thin trade, about 123,000 shares a day. This company, it's a mattress retailer, as the name would suggest, went public in November. So it's only been on the market for a few months. And again, you could see it kind of meandered along a little bit after the IPO right in here. Had a very small run up and then kind of pulled back. So some awkward trade, but you had a potential entry point here, a couple potential entry points along the way. Right now, it's out of buy range. What happened here, this reported last night and beat earnings views, obviously. As you can see, I am on a daily chart. Obviously, you can see that the earnings report did make the street very happy. They completed an acquisition of something called Mattress Giant, another mattress retailer, and this is just a company that is in very fast growth mode. Goes exactly back to what I was talking about at the top of the show, that some of these newly public companies can be very, very fertile ground for price gains, just because they can be, they're in growth mode. That's about it. They're not mature enough. They haven't exhausted their growth potential. So, okay, there's David Bowie telling us to get out of here. So I will be back in just a few minutes after the break. 877-927-6648. I'm Kate Stalter, sitting in for Larry Pesavento with my own spin on Trade What You See. We'll be right back in just a few minutes.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. You take a hands-on approach to managing your investments. And whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you seek to maximize your returns. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of The Money Game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, just kind of grooving to the music there. I've put up a chart here. I'm Kate Stalter, by the way, sitting in for Larry, in case you just decided to, in case you just tuned in on the show and are wondering, hey, where's Larry? Who's this person? I'm Kate Stalter. I'm normally the host of the Small Cap Roundup on Tuesday and Thursday at 11 a.m. Eastern, and I'm just thrilled and honored that Tom and Larry have allowed me to sit in on the show for the past few weeks now. It's been a lot of fun. What I'm doing here today, I wanted to take a little time to go over some recent IPOs, because that's an area that I consistently focus on. I'm constantly running screens for new stocks. You just find a tremendous amount of opportunity in this area. So I'm putting up a chart for something called EPAM, E-P-A-M, and this is another one that I've followed for a while here, and I'm just kind of looking at that move yesterday, actually today, making a nice move. This is an IT outsourcer, and they are based in Pennsylvania. It's a small company. Let me see, market cap of about $911 million. Moving about 294,000 shares a day. I mean, decent volume. This stock only went public. I'm showing you a daily chart right here, and you can see, brand new to the marketplace. Went public just in February. Its IPO price was $12 a share, and let's see, as of today, it's trading at around 22.36. So you can see very, very nice uptrend in just the past few months on this particular stock. You know, sadly, it's out of buy range again at the moment, just having cleared this little pullback. I'm indicating it for you there on Tiger TV. And right now, you know, we're in a market downturn despite a lot of the jubilation I'm seeing in the mainstream media today. You know, which is another topic I could talk about for a long, long time, is just some of the, I believe, kind of hope springs eternal vibe that we're seeing out there today. You know, we have not yet seen any sort of confirmation that the market is out of its downtrend. And, you know, frankly, it's very, very common to see upside days, even in heavier volume. And I haven't really checked the volume in the past hour or so to see what's going on. I can do that right now, as a matter of fact. But, you know, it's very, very common to see upside days, even in heavier volume, when the market is in the midst of a significant downtrend. And, you know, who knows how significant this is going to be. So, yeah, it looks like we've got lower NYSE and NASDAQ volume today. So there you go. There you go. So despite some of the rejoicing that we're seeing out there, you know, we're not necessarily seeing the volume confirming it. And I'm sure some of you are out there thinking, well, we've had low volume rallies for quite some time. That's absolutely right. But if you do want to see an uptrend confirmed, most of the time, and there have been a few exceptions, most of the time, you are looking for some heavier volume. So, okay. So just taking a look there at EPAM, big move up in the stock today. An IPO from February could be one to continue watching. As I mentioned, this is another small cap. I've been tracking this one for quite some time. Now, the revenue growth has been solid. Earnings growth expected to be flat this year. And you know, for a newer company, you do sometimes see that as the returns are put back into growth. Not unusual to see that. Now, for 2013, some double-digit earnings growth expected. Of course, that can always change. Analyst estimates can be wrong to either the upside or the downside. But again, just kind of shows you where Wall Street's at with this particular very small, very new stock at this time. Let's see here. Oh, let me show you this one. I've got about a minute. This is another great small new stock that I've talked about on the show a couple times, and I know I'm bringing up the same ones, but hey, that's because they are strong performers. They're worth tracking. Okay, this is Ubiquity Networks. Went public at 15 back in October. Now, this is actually, you know, by a lot of measures, you would consider this in mid-cap range. By some measures, it's a small cap. Almost $2.9 billion market cap. Moves about 354,000 shares a day. And again, you can see this uptrend here. And what I like about this, okay, so Ubiquity Net, that's another one pulling back. Nice little correction here that we can see. So stick around. We have our guest, Edward Hornstein, who is going to talk about growth stocks and what he sees in the market right now. He will be back with us, joining us right after this break. I'm Kate Stalter, sitting in for Larry Pesavento on Trade What You See.
You've heard Tom O'Brien on the air, and you've always thought about trying out his newsletter, Market Insights. Well, now is the perfect time. For a limited time only, when you sign up for a 2-week free trial to Market Insights, we'll send you a free copy of Tom O'Brien's best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System. If you decide to cancel within the 2-week trial period, pay absolutely nothing and keep Tom's book as a free gift from us. Tom sends out his daily newsletter each morning by 9:30 a.m. with trade recommendations, including price targets and price stops. As recently as March 21st, Market Insights subscribers closed out a position for more than a 25% profit in just over 2 weeks. To get your 2-week free trial to Market Insights, along with your free copy of The Art of Timing the Trade, Your Ultimate Trading Mastery System, visit the front page of TFNN.com. Supplies are limited for this one-of-a-kind special, so act today and don't let this opportunity pass you by. Offer only valid for new subscribers. In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit TFNN.com today.
Folks, turns out my best student became my best teacher. Steve Rhodes absolutely raised my standards, and I'll guarantee he'll raise yours.
Thanks, Tom. What I've learned is that if you want more, you must become more, and that transformation, folks, that occurs the moment you decide to become a master. Now, the quickest way to mastery is through immersion, and for 2 solid days in Denver, Boston, and Tampa, I'll create a new standard of wealth for those few trader investors who have a burning desire to succeed. At my Master Trader course, I'll teach you how to create the ultimate money machine. These are the best-kept secrets in the business. Roadblocks, folks. Dabblers give up when they first appear. Stressors last just a little bit longer, but masters expect roadblocks and achieve extraordinary results when they bust right through them. I have all the benefit of knowing the type of wealth creation that I can generate for you. You don't. That's why I'm making this unconditional money-back guarantee. If for any reason you're not satisfied with my Master Trader course, I'll refund every penny. That's right. I take all the risk, and you get all the benefit. Go to the homepage at TFNN.com and sign up today.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
All right, welcome back. Kate Stalter here, substituting for Larry Pesavento this week and next week. So, very, very interesting observations about some of the market action today. Looks like looks like the indexes are gaining a little steam, but as I said before the break, last I checked, volume was lower. Now, we have on the line joining us today one of my favorite guests who I've spoken with many times, I believe both here a few months ago on my small cap show and also on moneyshow.com. I'm joined today by Edward Hornstein, who's an asset manager, market historian, growth investor, trend follower, just a lot of terrific market knowledge he brings to us, and he's from Hornstein Capital Management in New York City. So, Edward, I'm so glad you're joining us today. I wanted to get your take on what are you seeing in this bounce in the markets, a lot of jubilation in the mainstream media today. But what is your take on what you're seeing going on in the major indexes today?
Hi, Kate. Well, first, thanks for having me. The market appears to be bouncing here a little bit, but what I try to do, or the methodology I employ, is I try not to focus too much on each individual day. And if you kind of think about it from a trading perspective, you basically have 3 trends. You've got a long-term trend, an intermediate-term trend, and then a shorter-term trend. Of course, you kind of have a 4th trend, which is the super cycle, which basically we're in this secular bear that began in 2000. But for traders, that's the least important. The three key trends are the short, intermediate, and long-term trends. And, you can pretty much use moving averages to get a good idea. So, if the market's above the 50-day moving average, pretty much all other things being equal, the short-term trend is going to be up. If it's around the 50 or below it, then, the short-term trend is going to be down. The intermediate-term trend will probably be down, too. And then the longer-term trend can usually be defined by, the indices staying above their 200-day or 150-day moving averages. And, unfortunately, in today's world with the advent of technology, I think one of the disadvantages is that traders tend to focus a little bit too much on the short-term trend, which unfortunately is the least important of the major trends and really the hardest to game. And as many of the great traders throughout the past 100 years, William O'Neill, Jesse Livermore, Nicholas Darvis, found out really early on, if you can get the long and intermediate-term trends correct, you can pretty much ignore much of the short-term trend, and that stops you from getting whipped around. So going back to your question, we're certainly bouncing here a little bit, but I think it's important to keep in mind, especially since this is probably the market's first correction since we bottomed last fall, is that the long-term trend, the long-term bull, still remains up. And on the leading indices, the NASDAQ and the NASDAQ 100, even the intermediate-term trend kind of remains up, although it's come under a little bit of pressure. And the only trend that's really turned down is the shorter-term trend. So, given the move in the market since the fall, it's entitled to correct here. And that's what it seems to be doing, but there really doesn't appear to be on the longer and intermediate-term trends, at least at this point, any type of damage that would indicate to me that the bull market that began in the fall is over. So at least at this point, it looks like we're just getting our first correction, and, the market could go lower from here. Maybe we have seen the lows. Maybe it turns back down again. But until you see those longer-term moving averages break, and until you see the major leading stocks really break below those longer-term moving averages, I think you can only say at this point that the market has embarked on what is a normal correction so far.
Now, let me follow up with what you were saying about the moving averages, because that was really interesting. And I'm kind of just looking at some charts. I'm noticing that all the indexes are kind of flirting with those 50-day lines right now. The NYSE indexes are below that 50-day, the NASDAQ composite holding just above it. What do you make of that?
Right. Well, it's interesting that you hit on the NYSE, the New York Stock Exchange Composite, which is pretty broad and probably a better indicator than the Dow. Now, that's corrected substantially. So in the NYSE, the intermediate-term trend has definitely turned down. But it's important to realize that part of the reason is that the NYSE contains a lot of the commodity stocks, the metals, mining, steels, industrials, and those have not been our leaders this rally. Those have been extremely bearish, and even when the market was going up, they weren't getting much of the power. So the commodity and industrial space is certainly not a leading index, and that's one of the reasons why the NYSE is corrected so much and it's so far below the 50-day moving average. I've always been taught, and my methodology is to focus on what's working best. You want to be in the leading stocks and the leading indices, and the leading indices now are the NASDAQ and the NASDAQ 100. And if you look at the NASDAQ 100, and granted, it's weighted a little, it's weighted substantially by Apple, which is obviously one of the big leaders, so it's going to make it look a little bit better. But the NASDAQ 100 is comfortably above its 50-day moving average, and the NASDAQ itself held the 50-day yesterday and remains above it. The S&P, another broad index, is kind of right about at the 50-day moving average. The other thing to keep in mind is that indices can go below the 50-day moving average, and that's not necessarily the end of the world. That just kind of tells you that the short-term trend is turned down and the correction might gather some teeth. But in order for me to even start to think that the bull market that began in the fall might be over, I would need to see the NASDAQ and the NASDAQ 100 clear and unequivocally break the 30-week or the 150-day moving averages. As long as they hold above that, as far as I'm concerned, this is a normal correction that could go lower, but doesn't necessarily end the longer-term trend that began in the fall.
Let's talk a little bit then about some of the market leaders. I mean, obviously, you mentioned the obvious one that I think we all know at this point, which is Apple, and I've put a chart of that up there. What else, though, are you looking at right now that's one of the top performers?
Well, I think the two big liquid leaders are Apple and Priceline, and they both gapped out of bases and broke out a few months ago. And if you look at them, the price and volume action, those are just two key leading stocks. Now, they look like they're pausing a little bit here. And they're extended from their 20 days. They're extended from their 50 and 10-week moving averages. So these stocks could certainly use a little bit of rest and pull back. But again, as long as Apple and Priceline don't break their 10-week moving averages on volume, I think that bodes well for the broader market. In terms of other stocks that are providing leadership, Chipotle, CMG, has obviously been a big leader. If you look at a weekly chart, that stock has pretty much gone straight up. It's been a little bit slower than the other ones, but it hasn't even had a down week since it broke out. And that's how you can really gauge the sign of institutional accumulation. It's much easier on a weekly chart than a daily chart. If you look at a weekly chart and a stock's gone up 5, 6, 7 weeks in a row or more, even if volume is a little bit lighter on the daily, that pretty much just tells you that the institutions have a big appetite for the stock. So if you look at Chipotle, again, stock is extended here, but if you own it, great, and you bought it properly, great. But even if you don't own it, it's important to keep your eyes on that and an Apple and a Priceline just because they're going to give you clues about the general market. I'd say LinkedIn is another stock that's provided leadership. A newer IPO, again, if you look at the weekly chart, the volume is just tremendous. And now it's pulling back to the 10-week moving average. It's sitting on the 20-day moving average. Volume is light. So if and when the market comes out of this correction in the next few weeks, I would look to that to see if it can lead. I'd say also Intuitive Surgical. I think I had talked about that a few months ago on your show. That continues to provide big leadership. It's a little bit thinner. Another one, if you look at the weekly, you can see that it's just up a tremendous number of weeks in a row. I'd say Lululemon is another stock. It's up about 60-70% this year. It acted well on earnings, and if you look, it's just kind of pulling back into the 50-day moving average right now, but you can see that the trend remains up in that stock. In terms of some newer stocks, one IPO I'm actually keeping my eyes on is a company called Annie's Inc. The ticker is BNNY, Barry, Nancy, Yellow. This is a newer IPO, and I actually know them well because I have a 3-year-old son who absolutely loves to eat the snack products that they make. But they basically make some natural and organic packaged foods. A lot of stuff for kids, healthy snack alternatives. And if you look at this stock, it had a really strong reception on its IPO. It came up to about $40. And now it's just kind of pulling back as volume dries up. And one thing I like about this stock is that if you see with some newer IPOs, they tend to be extremely volatile, and they trade all over the place. If you look at Annie's, though, at least now, it trades a little bit more maturely. Even yesterday and the day before when the broader market got hit, it really didn't go down that much. And today it's kind of just flatlining. You can see it's nice and tight between that $37 and $40 area, and could certainly use a little bit more of a pullback. But the fundamentals are big on this stock. The story is pretty interesting. And the stock trades extremely tight and mature. So, again, if and when this correction ends, that's another stock that I'd be looking at that could potentially come out and provide some leadership.
Let me pause there for just a second.
One other stock I'm actually watching today is Salesforce.com. So that's a name that's obviously been around for a few years. But, again, just going with the theme, if you look at the weekly chart, the stock's up about 13, 14 weeks in a row off its low. So that's just showing you that the institutions are very interested in the stock. And it's kind of just been pulling back along its 20-day moving average. It's kind of flirting with a new high today. Whether it breaks out or not, I don't know. But, if the market correction should deepen, this thing could pull back a little bit more. But it's certainly a stock I'm looking at. It's got the fundamentals of sponsorship and the technical action that if and when this correction does end and we thrust higher again, could provide some leadership.
Interesting list here. I want to come back to, actually, you've made a few good points. I know, for example, CRM is one that, you would have thought had been given up for dead, and unless you'd been tracking the chart, you wouldn't realize how strong it's been lately. So that's a terrific observation there. But I want to come back to Annie's, because, I think just about all of the other stocks you named were either larger mid-caps or just out-and-out large caps. And Annie's is definitely a small cap. I know there was some news that broke yesterday or the day before that Stephen Cohen's hedge fund was among the investors in there, so you do see it has some good institutional support. But, Edward, what's your take on small caps in this market? I mean, I do understand that the bigger, more liquid stocks have been the leaders in recent months, but I do host the small cap show. It is something I follow, so I'm interested to hear your view on that.
Yeah, well, generally, we're probably in the third leg of a bull market that began in, about March of 2009. We had the correction in the summer of 2010, or after the flash crash, and then last summer's correction. So it's been going for a while. And what generally happens as markets mature is that you get a rotation. You have a smaller cap and mid-cap stocks usually lead earlier in the cycle, and the larger cap stocks will generally, not always, lead at the end. So I think it's pretty normal, given where we've come in the past 3-4 years, that the large cap stocks are leading. So I think that's the first and most important thing. You always want to be tracking where the money is flowing. Is the money flowing into small caps or large caps? Right now, generally, the money is flowing into large caps, and it's not necessarily that I like large caps better, and that's why I'm naming them. These are just the ones that are under the most accumulation. Now, with small caps, you are going to get a few that could outperform. One of the things to look for is called, I call it a stock that's growing up, and a perfect example is KORS, Coors. When that stock came public, it was about a $25, $26 stock that traded about 750,000 shares a day. And granted, they issued some more shares, but now it's like a $43, $44 stock that trades about $3 or $4 million a day. So the key for small caps, if you really want to get quality, is A, tracking the volume. And if we're watching Annies, we want to make sure that if the stock starts to take off in the next few weeks, you really start to see volume expand, which shows that the institutions are taking an interest in the stock. The other thing that's very important for small caps is smaller caps can be extremely volatile. And they can move just a lot on a daily basis. It's always fun when they're going up, but when they're going down, they can shake you out. What I found is that the small caps that are going to grow up to be the big leaders are generally going to show signs of trading much tighter early in their inception. So even if they're a little thinner and smaller, like in Annies, you're going to see that tightness. And what that is showing is that the institutions are in there, and they're controlling the ebb and flow of the stock, and it's not just a bunch of retail investors without the institutional sponsorship. So again, just to summarize, the two things you want to look for in a smaller cap stock, if it's going to grow up to be a big leader, are you want to see that the stock has expanding volume and is starting to trade more maturely as volume expands as it goes up. And secondly, you want to make sure that the stock is controlled and trading extremely tight, even if it's thin, because that's another sign that the institutions are slowly coming into there and controlling the stock, and that's ultimately what's going to make the stock go up.
Yeah, that's another one of those interesting observations, because I have noticed that a lot of these things, I was writing about one yesterday that had, a beta of like 2.3 or just something out of control. And those are the places where you've just got to really, really watch your risk.
Yeah, and if you think about it, we all know what makes a stock go up is not Aunt Mary, Uncle Bob buying, but it's the giant institutions that are continually buying stocks. So the thing is, with smaller cap stocks, if you're a Fidelity or a Vanguard and you want to buy a lot of the stock, very small stocks, it's very hard for them to do because the shares just aren't available there. So you really, really want to look for signs in a smaller cap stock that, as hard as it is, there are institutions that are coming in and trying their best to get shares, even if it's thin. And I think the best way to do that is to look for tightness. Now, INVN was a stock that was a leader for a while. I was never too thrilled with that stock, and I never owned it. And one of the reasons is, while the story is great, it was just too volatile. It was going up and down every day, 5%, 10%. And to me, that's a sign to stay away from it, that institutions really aren't controlling it. And, I'm going to miss one or two stocks that are thinner, that trade wildly, that go up. But it's more important for me to really make sure that when I'm buying a small cap stock, I'm increasing the probabilities that it's got institutional sponsorship. And the best way I know to do that early on before the institution...
At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, I just want to let you know I did give you some jewelry. My jeweler offered me about $650, but you get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
on?
Well, I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, good.
And I'm very happy.
Well, I appreciate it. Now, did you sell us jewelry or did you buy coins off us?
Yeah, I sold you jewelry.
Okay.
Yeah.
Awesome.
What we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's just wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
I want to get right back to this. We've got just a few more minutes here, and we were able to get Edward Hornstein to stay on the line with us today. So, Edward, we were talking about InvenSense. INVN, and I just wanted to interject. I agree with you. I liked that stock for a while in there, but the volatility as it started to fall from its highs did kind of make me nervous. And it was interesting because, just a few weeks ago we had there were some pretty high-profile money managers who use some similar styles to the ones that you and I use, who were still kind of recommending that even on the downside, and I had my doubts. So just we got a couple minutes. Give us your take on this.
Yeah, well, again, I mean, the stock looked good and me and my firm never owned the stock, so, I wish I would have owned it for a while. I mean, it went up 200% pretty quickly, but I tend to want stocks that are, again, institutionally sponsored. Now, the liquidity went up a little bit at the end of its run, which was nice. But even when it was going up, there were days when it was down 7-8%, and it just never really traded that tightly. It was always very wide and loose. And to me, again, there is no perfect science, so you can get wide and loose stocks that turn out to be big winners. But this game's just about probabilities. And more often than not, when a stock's trading up and down every single day, 8-10% all over the place, it's generally a sign that institutions aren't really sponsoring it, and it's more of a retail-oriented stock. When there are institutions in a stock, they want to control it. They've got to buy more. They want to support it. They want stocks that are calm, and they make the stocks calm. That's why you see tightness, because they're controlling the ebb and flow of the stock. So it's just an old trick or tool that I use when I'm looking at small caps. I want to make sure that the stocks are tight and that the stocks, have sufficient volume. And that's one of the things that attract me to Annie's, besides the fact that the IPO was received very, very well. It's almost $40, is that at least right now, it trades very, very tight. So, should the thing pull back or sit around, I'd be looking, after this correction is over, does it thrust into new high grounds and does volume pick up? But for now, so far, so good. But, I'm just watching it here because for all I know, the thing doesn't work, and if it goes lower, so be it.
We've got just about little over 30 seconds here just to wrap this up. I posted here in our chat room, our Tiger Den, you are going to be speaking at the Dallas Money Show in June. Can you give us just a quick headline of what it is you'll be speaking about?
Sure. I think the dates are the June 8th to 10th. I have to check it. But, if anyone just Googles Money Show Dallas Traders Expo, it'll be there. I'm speaking on Friday afternoon, and what it is just an event where, traders and investors get together, share ideas. I know there's some booths there and some other speakers that are pretty well regarded in the industry. And I'm just going to be giving an hour presentation just on, buying leading stocks like I discussed, when they're shaking out and when they're pulling back, kind of like what they're doing now. Just to kind of take the other end when a lot of people are getting shaken out, just some tricks that I use based on my historical studies to try to, buy them as they're shaking out, coming off support. So if anyone is in the area and would like to come, I'd love to have you and would look forward to meeting anybody.
And I'll be out there too, so they can stop by the show and hopefully meet both of us. That would be great. Hey, Edward, as always, wonderful to have you join us today. Would love for you to come back sometime. I know you've got a lot you can talk about on market history. That's a whole topic unto itself, so we should do that sometime. So thanks so much for joining us. And we got to wrap up here today in just a few seconds, but just to remind everybody, I will be back with the Small Cap Roundup, and that is Thursday. And that will be at 11 a.m. Eastern. And wow, did Edward give us some great perspective today on how to analyze some of the small caps. A lot of these newer names that we look at do tend to be pretty volatile, but we always have some new tools to analyze these with and decide whether or not they're good portfolio additions. So, okay, thanks again to Edward Hornstein. Thanks to all of you for joining us. And we'll talk to you again tomorrow, 11 a.m. Eastern on the Small Cap Roundup.